Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Asian stocks extending a global rally. The S&P 500 and Nasdaq 100 hitting record highs while Treasury yields retreat. Cooler U.S. inflation reinforces bets on Fed cuts, with swaps now pricing in 2 reductions this year, starting as early as September. Plus, more great conversations here at the Qatar Economic Forum. We'll speak exclusively with EQT Group CEO Christian Sinding and Jumia CEO Dufay. Well, it's just gone 8 a.m. across the Emirates, 7 a.m. in Qatar. I'm Joumanna Bercetche in Doha. It is the final day of the Qatar Economic Forum, where business leaders and heads of states have been discussing the issues dominating the global agenda. The Gulf's rising importance has also been in the spotlight, and shifting influence, money flows, and geopolitical risks also high on the agenda as well. On the docket today, UNDP's Africa Director Ahuna Ejekonwa and global venture founder Noor Suede. We will be discussing AI regulation, what is in focus for VCs and fintech, and innovation on my panels throughout the day. Today, I would say, is the tech-focused day of the Qatar Economic Forum. So as you can imagine, plenty of things to discuss, including AI, of course. But first, a check on markets. We had been anticipating that CPI print all week, and let me tell you, it did not disappoint the market, showing some moderation with that core CPI number cooling for the first time in 6 months. What was the reaction? Strong reaction in risky assets. You can see the S&P 500 piercing through 5,300 now, up 1.1% for the session. Its 23rd record close in 2024. Similar theme for the Nasdaq, up 1.5%. Another record close for the tech index there as well. 10-year yields, well, that slightly cooler number sent 10-year yields about 10 basis points lower. 4.31 is where we are right now, around 2.7 basis points lower on the session, building on from some of the gains yesterday. And then the USD now sitting at a 1-month low. So again, giving back some of the gains from the last month. This as the market starts to price in further rate cuts. So this is what the market is pricing in for the end of the year. 50 basis points worth of cuts. That is 2 Fed cuts of 25 basis points each. And remember, this market has been oscillating back and forth throughout the course of the last couple of months. At one point, we were close to 1 cut priced in, now back to 2. And it remains to be seen whether or not this is going to be matched up by some of the rhetoric that we are getting from the Fed. And to that effect, we heard from the Minneapolis Fed President, Neel Kashkari, in a discussion on the restrictiveness of monetary policy. He repeated his view, and of course he's a hawk, that rates may need to be held for longer.
How much downward pressure is monetary policy putting on the economy? That's an unknown. We don't know for sure. And that tells me we probably need to sit here for a while longer until we figure out where underlying inflation is headed before we jump to any conclusions.
So strong reaction for S&P and Nasdaq. Let's check in on how markets in Asia are faring. Avril, have they caught the same bug as U.S. equities?
Oh, absolutely. It is that U.S. CPI effect that's playing out in the Asia Pacific. The stock gauge for the region is climbing by the most in 2 weeks. We're also seeing bonds and currencies really in the green today. And if you're wondering why the Australian stock benchmark is seeing outsized moves, that's because we got a jobless rate surge that is prompting expectations of an RBA rate cut. We're also seeing the Japanese currency climbing. It's really about those lower U.S. yields. And mind you, this is on a day where we're seeing tempered expectations of a BOJ rate hike. No thanks to the Japanese Q1 print coming in with a contraction that was deeper than expected. Let's flip the board and take you to Hong Kong, where the Hang Seng went into the lunch break with gains. This is, of course, a day after that break, and traders getting their first chance to react to earnings from Tech 8. It was a divergent performance. Tencent beat, Alibaba missed, but the Chinese developers listed in Hong Kong, this gauge surging 13% is what we're really tracking. It's really about those expectations of policy support for the property sector. Joumanna.
Avril, thank you so much for the overview. It seems that risk-on sentiment is driving all assets today. Now, in geopolitics, the U.S. has warned Israel it risks creating a power vacuum in Gaza, urging the country's leaders to focus more on post-war planning. Israel's gradual deployment of troops into Rafah appears to be the start of a full-blown invasion of the southern Gaza city. Secretary of State Antony Blinken says the U.S. is worried about the blocking of aid for the Palestinian territory.
One of the Deep concerns that we have is the impact of this limited operation that we've seen to date in Rafah on the ability to provide humanitarian assistance, because the two main points of access in the south, Rafah itself and Kerem Shalom, have been affected by the resulting conflict.
Meanwhile, former U.S. General David Petraeus, who commanded forces in Iraq and Afghanistan, says Israel has no real post-war plan. Speaking exclusively to Bloomberg editor-in-chief John Micklethwaite, Petraeus says Israeli troops need to change tactics to prevent Hamas from regrouping in areas of Gaza.
You have to clear and hold and keep the enemy out of the people. If you don't keep the enemy from reconstituting, if you don't keep the enemy from getting back into the population, this is going to happen endlessly.
Joining us for more analysis is Bobby Ghosh, Bloomberg senior editor. Bobby, fascinating discussion John Micklethwaite had with Petraeus yesterday, and I think there was a lot of conversation about not just what's happening with the war, but what happens afterwards, and that is a big question mark, isn't it?
That is very much a very big question mark. Now, I lived in Baghdad. I was in Baghdad when Petraeus was implementing the policy that he was discussing yesterday, and I think the point he was making is that it's not enough just to go and bomb a neighborhood and then push people to the next neighborhood, then bomb that neighborhood, and so on, which is essentially what we've seen Israel do. The key is to make sure that the neighborhood that you have cleared cannot then be reoccupied by Hamas. And to do that, you have to be able to hold that neighborhood. You also have to make sure that the people, that the civilians, you make a distinction between the civilians and Hamas. You make sure the civilians are protected from Hamas as well as from yourself. You make sure they get medical attention and the aid. Basically, everything that the Israelis have not been doing is what Petraeus says they ought to be doing. We've also seen, and it's not just on our stage here, we're hearing the same things from within the Israeli war cabinet. The defense minister, Yoav Gallant, came out overnight and completely disagreed with his prime minister, with Bibi Netanyahu's strategy. So there are big cracks within the Israeli consensus.
And I think people are underestimating that division within the war cabinet and within the Israeli cabinet as well, because so far the interpretation was that it was the war cabinet who's pushing the Prime Minister Netanyahu in a more hawkish direction. But now you are beginning to hear the likes of defense ministers saying we need to have a post-war plan. So that
we need to have a post-plan plan, and another important division, whereas Netanyahu wants the other Arab states to come and provide peacekeeping for the post-war period, his own defense minister saying, no, that won't work. We have to take responsibility. Israel has to take responsibility. Again, we heard from Petraeus here yesterday saying no Arab state is going to want to go in there and clean up Israel's mess, not while Hamas still remains.
Yeah, and that echoes some of the conversations I've had. Another major geopolitical story I just want to bring you. So Russian President Putin is now in China, his first trip abroad since the elections. We're getting a few headlines coming through. President Xi is telling Putin that China is willing to be Russia's good friend. So that is being quoted on CCTV, national TV. Xi also adds to safeguard world fairness and justice with Russia. So reiterating the close relationship between the two. I mean, how should the rest of the world read this? Russia is engaged in a war in Ukraine. We talk about NATO, Western Alliance, talking about the need for extra weapons, beefing up the artillery and support coming from the West in this war. And yet China, on the other side, other economic superpower, are reiterating their alliance with Russia.
Yeah, and this was what we expected. This is music to Putin's ears, of course. But it's China just reminding the world that they have picked a side, and it is the Russian side. Xi Jinping was just in Europe. He made this long trip through Europe trying to tell the Europeans that China are your friends. But here he's on the other side showing the Europeans that he's not really their friend, because he's supporting, openly embracing somebody who is actively working to destabilize Europe, not just damage Ukraine, but destabilize Europe as a whole. So the contradictions in the Chinese position are very clear. Xi Jinping doesn't care about that. This is a photo op for a domestic audience, and Putin is very happy because this is exactly what he wants to hear.
And also, he's very happy because China buys their oil. And so my question is, what is China's impetus here? Is it political or is it economic, because they just want to buy cheap oil? They need
well,
it.
It's more than one thing. They're asserting their dominance over Russia. You know, this is a historical opportunity for China to basically have Russia where it wants Russia to be. It is China's way of saying to the world that we take a very different view. We don't necessarily go along with the Western consensus. And remember that there is a Cold War between the U.S. and China. We've heard that in these halls several times over the last 2 days. And China, in this Cold War, is charting out its own position. And by siding with Russia, it is reminding the world that we have a very different view.
Are we likely to get a meaningful response out of China to these new tariffs that are being imposed, do you think?
It's very interesting. You know, these tariffs were coming. Everybody knew they were coming. Perhaps not so strong, but we knew they were coming. So the Chinese could have had their response in terms of export restrictions or their tariffs locked and ready to go as soon as Biden announced they would announce. They didn't. Instead, all they did was send out a strongly worded statement. And that's really quite interesting because the Chinese position is not as strong as it used to be. Xi Jinping has to deal with a troubled domestic economy. The real estate crisis is real and getting worse. He can't afford at this moment to ratchet up the tensions beyond a certain point. There will be a retaliation. There'll be some. There can't not be. But it's very interesting that it hasn't happened immediately. And I would be very surprised if the retaliation was very, very strong. I think we'll hear more rhetoric than actual action.
Yeah. At the end of the day, they've got to protect the domestic economy.
They do.
Bobby, always good to chat. That was Bobby Ghosh, Bloomberg senior editor. Well, more great conversations are coming up here at the Qatar Economic Forum. We're going to be speaking exclusively with EQT Group CEO Christian Sinding and Jumia CEO Dufay. And later today, we'll be at JP Morgan's annual Global Markets Conference in Paris. Do not miss our exclusive interview with the CEO, Jamie Dimon. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joumanna Bercetche in Doha. Chinese President Xi Jinping has welcomed Russia's Vladimir Putin, who's beginning his first state visit since winning a new term in office. It underlines the importance of his relationship with Beijing as Russian forces press forward with a new offensive in Ukraine. Our Greater China senior executive editor, John Liu, has more from Beijing. And John, just give us a sense of what the Russian president is trying to achieve out of this trip.
Well, China is extremely important to Vladimir Putin's war effort. It is not only a market for Russian oil and Russian commodities, it is also a source of exports to Russia, consumer goods. A great concern for the United States, one that Secretary Blinken has voiced on several occasions, is the Chinese export of dual-use technologies to Russia, so things that could have both a civilian purpose as well as a military use. And so there is a real concern in Washington, in Europe, that China would ramp up its support of Russia's war effort, of Russia's economy. And Mr. Putin is here to make sure that he can get as much support as he can from Beijing.
You know, I'm going to put to you the same question that I asked Bobby earlier. And my question is, to what extent do you think this is all economically motivated because of the fact that China has been buying Russia's oil, very important customer for Russia throughout the course of this war. But then from China's perspective, they're getting access to below market rate oil.
So I would look at this a little bit longer term. This meeting between Presidents Xi and Putin will be, I believe, the 40th time that the two gentlemen have met. And so this relationship extends far longer than when the invasion of Ukraine happened. So there are a lot of natural factors that are pushing these two countries together. Both Russia and China have their differences with the United States and with the West in general. Both countries are trying to create more space on the global stage for them to both economically and geopolitically exert their influence. And they fit together economically. Russia is a big producer of commodities, of energy. China is a huge consumer of those things. And they share a huge border and a past where there was conflict. And so there's a lot of reasons for these countries to be friendly. The war in Ukraine has not changed those underlying factors. they are continuing to push forward. And I think as long as economically, politically, it makes sense, I think Xi Jinping will be committed to this relationship.
Yeah, and let me just ask you about Xi's commitment or support, rather, of the war in Ukraine, because as you say, there are lots of economic ties, there are trade ties, but it feels like he's gone one step short of fully endorsing the war in Ukraine. It's a nuanced approach.
I've heard China's position described, I think, very well as sitting on the fence but leaning very significantly in Russia's direction. And so China has provided support rhetorically at places like the United Nations. It's provided support in terms of economically buying Russian oil, buying Russian goods, providing goods in the form of exports to Russia. But at the same time, it has continued to hold off on providing weapons, on providing the sorts of equipment that I'm sure Vladimir Putin would love to have from China, mostly at risk of further alienating the United States.
Yeah, and that's the key question here. But I do like that analogy, sitting on the fence, but leaning in, leaning forward. It's a great way to describe it. Our Greater China Senior Executive Editor, John Liu, has more from Beijing. Now, for a look at some other stories that we're following today, the U.S. says it is accelerating arms supplies to Ukraine as the country's military confronts a Russian assault in the northeast. Russian troops are pushing deeper into the Kharkiv region, taking control of some villages close to the border. The offensive is stretching Ukraine's forces and may push Kyiv to redeploy units from the front line in the east. And Slovakia's Prime Minister Robert Fico has suffered life-threatening injuries after being shot in public. It is the first assassination attempt on a European leader in more than 2 decades. The 59-year-old is in hospital in a very serious condition following the attack by a gunman who police say had a clear political motivation. Fico returned to power last year as a force of opposition to EU institutions in Brussels. And a reminder that we'll be at JP Morgan's annual Global Markets Conference in Paris later today. Do not miss our exclusive with CEO Jamie Dimon. This is Bloomberg.
The last piece of the equation is Southern Africa. We haven't announced this yet.
Do you want to announce it right now?
We will. Yes, we will announce it now. Yvonne knows about it. We are at the final stage of an equity investment in an airline in the southern part of Africa. This airline will help us, will complement the operation of Kigali as a hub, the operation of Rwandair as the airline that connects west, east, north of Africa to the airline that we are finalizing the investment in the southern part of Africa.
Is it also a state-owned airline? Can you give us some insight?
You will find out.
Badr, this is But maybe give us some insight into the type of partner you were looking for, because there's very few airlines.
I'll make it very simple for you. You know, Southern Africa, you're talking about 2-3 airlines only. So pick one of them.
That was Qatar Airways CEO Badr Al-Meer speaking to Jennifer about an impending investment deal with an airline in Southern Africa. Anyone's guess? That's in addition to expanding its partnership with Rwanda's national airline. Rwandair CEO Yvonne Manzi Makolo told us that the Gulf carrier will help run a new $1.3 billion airport in the capital, Kigali.
We are working on the partnership with the airline, where Qatar is looking at taking 49% of Rwandair, and the airport as well, the new airport that's being built, where Qatar is the majority shareholder at 60%. So very exciting projects that we're working on.
How close is that to being done? Because many people have been anticipating that airport.
Well, we're looking at a completion of 2027. There's been a bit of delay due to redesign. Originally, it was a much smaller airport, but when Qatar came in, There was a whole redesign process. COVID slowed things down, but we're eagerly anticipating 2027 for completion.
And I wonder, when we think about things that are potentially getting in the way of Rwandair being at its capacity, I mean, a lot of people are talking about planes, right? Boeing and Airbus. How has that affected airline and aviation, you think, on the continent, would you say?
Well, it plays a big role because all of us are scrambling for the few aircrafts that are available. There's been a lot of delays in terms of delivery, but not only on new aircrafts. We're having a lot of supply chain challenges in terms of getting spare parts. So when you have a technical problem, the aircraft is on the ground for much longer than it used to be. So we're really hoping that this issue is resolved as soon as possible, and the supply chain challenges are resolved, and the pipeline for new aircrafts is open once again.
Do you have confidence that it will be resolved sooner
Yes,
rather than later?
I do, absolutely. It has to. It has to. For aviation to continue growing, it definitely has to be resolved, and I'm confident that it will be resolved.
Do you anticipate then, I mean, when we think about intra-Africa travel, it's already a bit botchy. I mean, how do you improve it in the interim while we are waiting for, these other manufacturers to fix their issues?
Well, for intra-African travel, it's a number of challenges. So we have the cost of operating within the African continent, which is much, much higher, sometimes almost 50% higher than it is in the Middle East, which makes ticket prices very, very expensive for our citizens. We have infrastructure challenges where airports are not being upgraded. We have challenges with visas. Traveling between African countries is a big problem. We have skills challenges, so a lot of focus has to be on training skilled personnel to run these airports and airlines.
That was Rwandair CEO Yvonne Manzi Makolo speaking to my co-anchor Jennifer Savazaja. And Jennifer will be in Kigali today. She's very busy at the Africa CEO Forum, where business leaders and heads of state from across the continent will be discussing economic opportunities. She'll be interviewing the MD of the International Finance Corporation and the CEO of MTN. And coming up, more great conversations here at the Qatar Economic Forum. We'll speak exclusively with EQT Group CEO Christian Sinding and Jumia CEO Francis Dufay. Let us take a quick look at markets as well. Before we head out, you can see that equities are doing extremely well after that slightly weaker than expected CPI print. S&P futures, NASDAQ, both sitting at record highs. The Dow futures also seen opening up in positive territory. We will have this analysis and a lot more when we come back from this break. We'll be right back. Good morning. This is Horizons Middle East and Africa. Our top stories this morning. Asian stocks extending a global rally. The S&P 500 and NASDAQ hitting record highs while Treasury yields retreat. Cooler U.S. inflation reinforces bets on Fed cuts, with swaps now pricing in 2 reductions this year, starting as early as September. Plus, more great conversations here at the Qatar Economic Forum. We'll speak exclusively with EQT Group CEO Christian Sinding and Jumia CEO Francis Dufay. Well, it's just gone 8:30 a.m. across the Emirates, 7:30 a.m. here in Qatar, and I am Joumanna Bercetche in Doha. It is the final day of the Qatar Economic Forum, where business leaders and heads of states have been discussing the issues dominating the global agenda. The Gulf's rising importance has also been in the spotlight amid shifting influence, money flows, and geopolitical risks. So plenty of conversations still coming. Today is actually going to be a tech-themed day. A lot of discussion about the opportunities in AI, as you can imagine, and other major topics in that space, including fintech and disruption in tech in general. Quick check on markets. The big event yesterday, of course, was that CPI print showing that core CPI number had actually dropped for the first time in 6 months, spurring a big rally in equities. You can see the S&P 500 ended up through 5,300. NASDAQ also 1.5% higher. Another record close for 2024. 10-year yields also rallying about 10 basis points, another 2.5 basis points lower today, sitting at around 4.3%. The U.S. dollar now at a one-month low. And of course, the market was quick to start pricing in the possibility of further rate cuts out of the Fed after that cooler than expected print. We are now pricing in 2 cuts or 50 basis points worth of cuts by the end of the year. But let's check in also on how markets in Asia are faring. Avril Hong is in the Singapore studio standing by. We are also seeing positive momentum in some of these Asian markets as well, Avril.
Indeed, and Asia's stock gauge is climbing to the highest level in about 2 years. But I also wanted to draw your attention to data out of Japan. Q1 GDP contracting deeper than expected. And this is as consumers, companies cut back spending. So that's tempering some of those expectations that we're going to see a BOJ rate hike. Let's go cross assets and see how that's playing out in Japan. Flip the board if we can, because we're seeing, despite the gains on the Nikkei, thanks to the surge in tech stocks, that the topics has been pretty flat. This is getting the drag from automakers because of the stronger Japanese currency. It's about those lower U.S. yields, but also Japanese lenders. Their stocks are down. And remember how the BOJ rate hike could actually be something that supports their profits. So that's what we're seeing in Japan today. Joumanna.
Avril, thank you so much for the latest and an overview of some of those Japanese markets as well. Now, the private equity deal machine appears to be reawakening along with IPO momentum. That is prompting some firms to look beyond traditional measures to generate cash. Joining us now is Christian Sinding, CEO of the listed private equity firm EQT. Good morning. Welcome to Doha.
Thank you. Good morning, Joumanna.
I just want to start off with a question about the general private equity landscape, because my feeling is that companies are just staying private for longer. The exit has become a lot more challenging. Why do you think that's the case?
Well, if you look at the last 5 or 6 years, pre-pandemic, when interest rates were really low, multiples were very high, there was a lot of deals. We had a lot of compression in how quickly our industry invested. So we took a lot of capital from our investors, invested that quickly. And in the cycles in the past, we've been able to return about twice that on a normal pace, 3.5 years or so. Then interest rates rose, multiples came down, there was a fear of recession, so M&A activity reduced, and that means that we've invested a lot of capital in our whole industry, but we haven't been able to do enough exits.
Yeah.
So right now, there's a big push for various forms of exits in our industry from all of our companies, whether it's going public or trade sales, or sales to other financial buyers, or other structures like private IPOs that we're trying to innovate in the private markets.
And is the pressure coming from the LPs to get to those exits? There's also a push and pull here because you want to exit at the right opportunity, but at the same time, you don't want to hold on to these assets for too long.
Yeah. So there is, for some firms, there's some pressure. But there's also portfolio construction. As a manager, we own about 300 companies around the world. And of course, you want to make sure that that portfolio turns over so that you create liquidity for the investors, that we create liquidity for ourselves, and that you don't end up with too many portfolio companies that are then a little bit harder to manage. And I think it's important also, there's been a number of questions in the industry about the valuations of private markets.
Yes.
And of course, when you monetize and you actually do the exits, you prove that the valuations are healthy. So there's also a bit of that for some investors who want to see how this all plays out.
Well, you've also recently spoken about, introducing these more long-term structures and committing to a longer time frame.
Yeah.
What is the appetite for that for, some of the, say, bigger investors from the region, the sovereign wealth funds out here?
Yeah, quite a great question. If you look at a typical portfolio of private equity, there'll be 15 or 20 companies in that portfolio. And maybe 2 or 3 of those are superb companies that can grow and grow and grow.
Yeah.
And not all of them want to go public. Not all of them should be public.
Right.
So we want to create structures where we can run with those winners, we call it. Run with the winners for longer.
Yeah.
And then we need to set up structures for that. So either you do that in a new fund, or you set up continuation vehicles, or like we're playing around with this idea of a private IPO, where we keep the company privately, but we create a market in the equity of the company in the private markets. And the industry is now big enough enough and liquid enough that we think that's possible.
Yeah, that makes sense. Let me ask you another macro question. Given, I was just speaking about the market now pricing in 2 rate cuts out of the Fed. Other people in the Fed are saying rates are going to be higher for longer. How does that affect the outlook?
I think what's really important is stability. So if you look at why the markets were so slow for a while, both the credit market, the equity markets, and the private equity market, it's because there was a lot of uncertainty about interest rates, about inflation, and about the economy. So once you get some stability, for us, it's not that important that interest rates are coming down. It's more important that we have confidence that we can move into this new period and kind of expect what's going to happen.
Yeah.
And I think that's where most players are in our industry. So right now, activity is really picking up. It's great to see both private sales happening, IPOs happening, and activity from all players, actually.
Well, the big word that everyone talks about is artificial intelligence. How much are you leaning in to artificial intelligence in your portfolio?
We're leaning in big time. We actually started our artificial intelligence unit called Motherbrain back in 20. Yeah, it's pretty cool. It was a project name, and now it's kind of a brand. So we have 40 data scientists at EQT just working with AI.
Wow.
So it's both on the general AI side, which has now been accelerated with OpenAI and all these things, and also specific use cases or really specific AI. And we have big initiatives to roll this out to all of our portfolio companies, which of course is a big challenge, but we think it's better to take on the challenge, really try to integrate AI into your operations, your strategy, your thinking, than just to dabble a bit, which a lot of people are doing. This is going to shift the world big time.
Yeah, I mean, that's the thing. A couple of years ago, everyone was talking about blockchain, and blockchain also disrupting and changing the world big time. And then you fast forward a couple of years later, and there is some implementation of blockchain, but it hasn't really got to that wide-scale adoption that people were hoping for, I think, in the space a couple of years ago. And I just wonder whether, at this point, there is too much hype around artificial intelligence, because not all of these companies are going to be winners.
I agree. But I think if you look beyond the winners, which are incredibly highly valued, the whole ecosystem around that, all the services that they need, all the, the data centers, the fiber optic cables, the software, the tools, everything that's needed to power this. It's a huge industry, and it's going to be growing a lot. And we think this is going to have the same kind of effect on the world as the introduction of the iPhone, for example. It really is something different than blockchain, which was very specific for certain use cases, currencies, and other things. But this actually can impact all industries, including media, including our industry, knowledge, how to work.
Yeah, don't give them the idea. Bloomberg.
No, it's not as fun, definitely.
We're here in Doha, and I just want to get your assessment of the opportunities in the region and how you see the financial center evolution.
Well, it's actually really exciting to be down here. And I know you live down here, so it's there's lots of population growth, there's economic growth. The financial institutions and pension funds and sovereign wealth funds are growing. There's a real willingness to invest in innovation and in infrastructure. So I find that quite inspiring, actually. And I've been here all week, and a lot of young people, a lot of forward-leaning mindsets. So we're very active in the region with our investors, and this may be a place that we come to invest over time as we continue to grow.
Yeah, well, sounds very promising. And the fact that you're here is a strong signal that that may happen in the future. Christian, thank you so much for joining me today.
Thank you.
That was Christian Sinding, the CEO of EQT. Now for a look at some other stories that we're following. The Saudi Sovereign Wealth Fund roughly halved its direct holdings in U.S. stocks at the end of the first quarter to a market value of about $18 billion. 13F filings also revealed the public investment fund dropped entire stakes in BlackRock, Carnival, and Booking. The fund no longer holds numerous tech stocks, replacing those stakes with call options. And Egypt has received a further $14 billion from its landmark investment deal with the United Arab Emirates. The transfer provides a further surge of dollar liquidity about 2 months after currency flotation. The $35 billion deal marks a turnaround in fortunes for Egypt following a 2-year economic crisis and a chronic foreign exchange shortage. And Turkish Finance Minister Mehmet has signaled that the government is unafraid to sacrifice some economic growth as it tries to lower inflation. Simsek told me that some trade-offs are worth living with.
There are no trade-offs between growth and disinflation. In fact, disinflation or low inflation is absolutely essential for sustainable high growth. We know that. But in the short term, some trade-offs may emerge. I think those trade-offs are worth living by. So my sense is there will be tolerance to some moderation in domestic demand. So we're rebalancing growth. We're changing the composition of growth. What we are pursuing is sustainable high growth, not boom and bust episodes. And that's really where price stability comes in. It's absolutely at the core of this program, and we are committed, we'll deliver, because it's very difficult to operate in a high inflationary environment, very difficult to attract FDI inflows. So the path to competitiveness is through higher productivity, of course, but that requires sound policies, and price stability is the core of that.
Welcome back to Horizons Middle East and Africa. I'm Joumanna Bercetche in Doha. Nigeria's biggest e-commerce company, Jumia, is strategically expanding into secondary cities. But as the online giant looks to tap into the growing number of rural Nigerians with internet access, the economy is facing high inflation and a sinking currency. Joining us now is Francis Dufay, the CEO of Jumia Technologies. Great to have you with us. Before I talk about some of the macro, I know you released your earnings a couple of weeks ago. Things are looking up. Tell us where the positive momentum is coming from.
Things are looking up indeed. This Q1 is a pivotal quarter for us. We've been in a very important turnaround, big transformation of the company for a year and a half now, and we're seeing all our efforts paying off. So now we're running the company with much leaner setup, much lower losses, although there's still some forex impact, but it's short term. And we're growing again in very significant ways on usage KPIs. So it's extremely important for us. It's validating the whole strategy that we've implemented.
Okay, so it looks like, you had 18 months of cleaning up, restructuring, reducing costs, and now you're focused on the growth opportunities. Where are those growth opportunities going to come from?
So Africa, as a continent, I believe is the last place on Earth with massive untapped demand.
Yeah.
We see the whole world being a bit saturated on the demand side. And in Africa, I think it's a market that's poorly understood, but there are hundreds of millions of consumers who are poorly served, very poorly, because of inefficient supply chains, lack of supply, bad logistics, you name it. It's a long list. And that's our job to fix it. And we're seeing a lot of demand. We're seeing demand growing extremely fast at the pace of population growth, pretty much. And there needs to be players who can serve it. That's what we're doing. That's what we're focusing on.
Let me ask you, is your strategy about bringing on new customers, or is it about getting more out of existing customers?
I think it's definitely both. We're running the company right now with about 2 million customers on a quarterly basis, which is extremely small at the scale of Africa. So we need a lot more customers. We're targeting to get a lot more customers from sheer value proposition that we're delivering. And of course, we want to expand what we're selling to consumers so we get a bigger share of wallet.
How does the macro situation play into your business? I mean, you talk about, increased cost of living, high inflation, an uptick in unemployment. How does that impact?
The last 2 years have been tough. There's no way around that. I mean, tough for business, tough for populations. It's impacted both supply and demand. And as a marketplace, we're in between. So it's not very helpful. However, I think we've built a business model that's extremely resilient to tough macro environment. Africa is our playground. We get used to it and we embed it in the way we run the business.
Is there a risk of expanding too fast, too quickly within the African continent?
So we're already operating 11 countries.
Yeah, and is it living up to your expectations?
Yeah, I mean, with different levels, of course. I mean, not some countries have different macro challenges than others, but we're happy with the scope that we have. We're not expanding right now, and we believe there's a lot more we can get from those countries, particularly big markets like Nigeria.
Yeah. How big is the Starlink business?
It's meaningful. It's not our biggest business, but it's meaningful. Most importantly for me, it's a very relevant addition to our value proposition to consumers. And it's a great example of what we can do with international brands.
Can you give us an idea of how many Starlink units you're expecting on
I cannot disclose numbers, but we're very happy with the numbers. I believe they are, and it's very relevant for consumers.
Yeah. So let me just ask you then, we can't get a lot of detail about Starlink, but what are the fastest moving products on the site?
Oh, that's pretty standard. You get shoes, fashion, clothing, appliances, TVs, smartphones, well, anything that a marketplace would sell anywhere in the world. The specificity of our market is that we're really embracing the entry-level middle class. That's where the bulk of demand is. So we're really focusing on affordable segments, affordable products.
Yeah.
So a lot of the brands that we're selling are not known in the US, for example. But that's the way we adapt to the purchasing power of our highly price-conscious customers.
When I think of the Amazon model, which is, of course, the template for e-commerce platforms, margins were very low. And especially in the e-commerce business, it's a low-margin business, but it's a margin of scale. Is that the philosophy that you have for your own platform as well? Build up the scale, even if it's at low margins, and then start introducing the other high-margin products, which is what Amazon did, essentially.
The philosophy in our business is, there's no such thing as another Amazon, right? It's a model, but we're not exactly Amazon. The philosophy in our business is that we need to build scale, of course. We know that customers are heavily price-conscious, so we need a very lean structure on our end. So we can deliver very low prices on everything, including delivery and all services. So we're really focusing on getting a very lean organization, very low costs. We divided marketing budgets by 3 last year. We're further reducing it, and we're focusing everything on an amazing value proposition to consumers. That's the mindset. That's what we're building, and I think it's a bit unique and definitely tailored to Africa.
Yeah. Let me ask you what the vision is for the company in 5 years' time. What does Jumia look like?
Oh, it's going to be a whole different.
Why?
The scale of the opportunity, the scale of the market is absolutely massive. Population in Africa will nearly double in 30 years. So we're looking at something that's unprecedented in the history of the world in terms of consumer demand. And Jumia, we are building the right fundamentals so we can tap that growth, so we can be the one company that's positioned to tap it. So this company is going to be a lot bigger. Scale is going to get us to profitability, obviously, and it's going to be completely different.
Francis Dufay, the CEO of Jumia Technologies, thank you very much.
Thank you very much.
All right. Also coming up, the Gulf region is becoming a key hub of growth for travel and tourism. More from my panel coming up next. This is Bloomberg.
It's being the country in which we've been having the greatest growth post-pandemic. It's actually 25% better numbers today than 2019, which is not the case outside the Middle East. So this is a place to bet, this is a place to be, this is a place to act. And you're probably going to have to do it different ways between Qatar, UAE and Saudi Arabia.
That was the CEO of hospitality group Accor, Sébastien Bazin, telling us that the Middle East is the place to be. The sentiment was also echoed in my panel on travel and tourism in the Gulf.
After the pandemic, the GCC was one of the fastest growing in tourism. It's recovered very quickly and the demand is very high. We have high connectivity airlines, so in Qatar, as Qatar Airways, as award-winning airlines, or in our neighbors, the Emirates or Etihad, and upcoming Riyadh Air.
GCC is the fastest growth region on the planet. It is for travel and tourism. Far beyond. We are already 25% better than 2019. The rest of the world is in between -5 to +5. And it's not by accident. Why is it growing that fast? It's because there is a plan, there's a vision, there's ambition, there is destinations, there is financial muscles, there is manpower.
This is a very important industry also for jobs. In the last 5 years, we added 250,000 jobs to the sector. 60% of these jobs were captured by women.
Well, that was the Qatar Tourism Chair, Saudi Tourism Minister, and Accor CEO on one of my panels yesterday. Plenty more coming up today. As we were talking about, this is the tech-focused day of the Qatar Economic Forum. I'm going to be sitting down with the Qatari Minister of Communications later today to talk about what Doha are doing in terms of trying to attract some interest in artificial intelligence, in addition to other panels we're going to be having about VC in the region and the use cases for, of course, AI. But this is a quick look at markets because we did have that all-important CPI print yesterday. Core CPI dropping for the first time in 6 months. A big signal to the market. Traders were quick to price in interest rate cuts for this year. 50 basis points now priced in by the end of 2024. S&P futures, you can see, pointing a little bit higher on the session today, up 0.2%. Similar for the Nasdaq after a strong close yesterday, another record high for the year. And focus on U.S. Treasuries too. Let's take a quick look at yields before we head out. We saw a very strong move in 10-year yields, about 10 basis points lower on the session yesterday. 10-year sitting at 4.32%. Overnight, another 2 basis points lower. We spoke about the 2-year yield, also 1 basis point lower today. The market pricing in 50 basis points of cuts by the Fed for the rest of the year. And of course, that has all had an impact on the dollar, not shown here, but the USD is now sitting at a 1-month lower. This is in reference to the DXY. So a lot of reaction in terms of a positive reception to that CPI from the U.S. yesterday. That is it for our show, Horizons Middle East and Africa. I'm Joumanna Bercetche in Doha.